diplomatic career for 4 decades and served under 8 US presidents. He has served as the Undersecretary for Defense for Policy and Undersecretary of State for International Security Affairs also. Ambassador Wisner has worked very closely with ex-Secretary of State Henry Kissinger. Also, Secretary Condoleezza Rice appointed Ambassador Wisner as the nation's special representative to the Kosovo status talks in 2005, where Ambassador Wisner played a crucial role in negotiating Kosovo's independence. Before joining Square Pattern Box, Ambassador Wisner served as the Vice Chairman of External Affairs for American International Group. He also serves in the board of Square Pattern Box Foundation. Welcome, Ambassador Wisner. Glad to have you with us.
Thank you.
Next distinguished panelist we have is Mr. Sunil Mehta. Just as a matter of introduction, he doesn't need one, but I'll still try. So Mr. Mehta has 37 years of leadership experience in banking, financial services, insurance, and investments with leading global and domestic financial institutions. So he has headed AIG in India for a long period of time. Apart from that, he was in charge of, he was in Citibank for 18 years, where he held various senior level positions covering operation risk, sales, risk processing, re-engineering, risk management, public sector businesses, and corporate banking. Mr. Mehta currently serves as the non-executive chairman for Yes Bank. Many of you have known him from that. Prior to that, he was also a non-executive chairman for the Punjab National Bank. He serves in various boards, including ACC Limited, Shashakt India Asset Management Group, Wilmo Fintech Private Limited, and Bodytrix Fitnex Private Limited. Apart from that, honorable mention with respect to his engagement on the distressed asset space, that he has been the chair on the Committee of Resolution of Stressed Assets, which was set up under the supervision of the Ministry of Finance in the Government of India. Thank you, Mr. Mehta. We are glad to have you here.
Thank you. Thank you, Nelson.
Next distinguished panelist that we have is Mr. Cyril Shroff. Everybody knows him in the Indian law firm circle, but I'll still try to introduce. Mr. Cyril Shroff has over 38 years of experience in the areas of corporate and securities law, dispute, banking, bankruptcy, infrastructure, private client, financial regulation, and others. He has been consistently ranked as the star practitioner in India by Chamber Global and often regards as the M&A king of India. A thought leader and known for advising many things of its kind transaction in India, he regularly gets recognized as award-winning professional across various practices. He is also the chairman of FICCI's Corporate Law Committee, member of the CII National Council, National Committee on Financial Markets, and others. He is also a member of the first Apex Advisory Committee of the IMC, International Media Center, Task Force of Society of Insolvency Practitioners of India, and members of the Media Legal Defense Initiative International Advisory Board. He's a member of the SEBI-constituted, more famously known as Uday Katak Committee on Corporate Governance and SEBI Committee on Insider Trading. Thank you, Mr. Shroff. We are glad to have you here. Next, we have Mr. Stephen Lerner. Stephen Lerner is from Square Pattern Box. He is the global chair in the Square Pattern Box on restructuring insolvency practice group. Having practiced for more than 35 years, Stephen has extensive experience on national and cross-border restructuring practices in which he represents debtors, committee on unsecured creditors, secured and unsecured creditors, equity interest holders, and acquirers of troubled businesses in Chapter 11 reorganization cases, Chapter 9 municipal restructures, Chapter 15 cross-border cases, and out-of-court restructuring throughout the United States, Europe, Asia, South America, and most recently in the United Arab Emirates and India. Stephen has led the representation of clients in prominent cases of Lehman Brothers, Enron, Chrysler, WorldCom, General Motors, Dan Gas, the city of Detroit, among many others. Thank you, Stephen. We are glad to have you here.
Thank you.
And after that, we have Mr. L. Vishwanathan, again from Cyril Amarchand Mangalas Group. Mr. Vishwanathan has a rich experience in infrastructure and energy projects, project finance, banking services in India's leading corporate and financial institutions on infrastructure projects and banking and financial deals, and has expertise related to regulatory aspects of major energy projects. Mr. Vishwanathan had advised banks, financial institutions, private credit providers, as well as India's large corporates on broad range of transactions, including structured lending, corporate debt restructuring, strategic debt restructuring, and recovery of loans and investment. He has advised many insolvency proceedings under the IBC Code India IBC 2016. He has acted in several landmark transactions, which include Swiss Ribbons versus Union of India, Dhabol Power Projects, Tata Motors acquisition of Jaguar Land Rover, just to name a few. Thank you, Mr. Vishwanathan. We're glad to have you here. Last but not the least, we have Mr. Dhananjay Kumar, partner at the Sri Lamachand Mangaldas. Mr. Dhananjay Kumar advises leading banks and financial institutions, as well as developers on aspects of debt restructuring, security enforcement, infrastructure projects, structured finance, recovery of loans, banking, and insolvency matter. He is advising leading banks, office holder, and ARCs in various cases under the new IBC law in India. He specializes in projects and project finances and focuses mainly on oil and gas sector, telecom, and port sector. He advises both lenders and developers in the infrastructure sector, as acted for many key players in this space. So thank you, Dhananjay. We are glad to have you here. So with this long introduction, I hand over to Ambassador Wisna for his initial comments. Thank you.
Thank you, Nelson. It is a pleasure to join my colleagues today and all of you as participants in the webinar to reflect for a moment on this extraordinarily important topic. But let me first state the obvious, and that is we're living in quite extraordinary times. 2020 is a year none of us will forget, and there's still 5 months to go. Turmoil surrounds us in our domestic politics, international relations, and in the performance of our economies. Everybody has been hard hit. COVID-19 continues to rage through our nations and ravage our populations, even as we work and pray for an effective, safe vaccine. It is still some time in coming. Even as I sit back today and look at the global situation, and particularly at India and the United States, I have to fear the persistence of weak economic performance. But that doesn't let any of us off the hook. We owe it to our fellow countrymen, our colleagues in the marketplace, to focus on economic recovery, to focus on how to resume economic growth. The key, one of the keys to achieving these two goals is to manage the overhang of distressed assets. They are storehouses of great value. They are potential platforms for future growth. That they're a challenge. It's a challenge to all of us to figure out how to convert these storehouses of value into growth engines. I am not alone in believing that India offers significant opportunities in restructuring, refinance, and I believe, as a general matter, the field of restructuring and refinance is a fruitful endeavor for US-India cooperation as we bring both technical and material strengths to the table, and India brings its own huge endowments. So I hope today we will explore what's going on in the marketplace, where we're headed. American investors in particular need to understand the dynamics of the Indian marketplace, your rules, your regulations, and our Indian colleagues need to understand better who we are and what we bring. So let me turn the floor over to all of you. I listen keenly to the proceedings.
Sunil, I think, are you going to offer initial comments now? I think I will follow, but let me just sort of actually take it from here. And so it's first of all, thank you to this wonderful panelists and all the participants from different time zones who have joined us, and we would definitely benefit from their comments and views as we progress during this webinar. I thought it would be important for me to just lay out the size of the problem that we have in the country, if I can even come close to that. On a pre-COVID situation, we were about $200 billion to $250 billion of stress assets. That number, I would imagine, has grown significantly, and we are dealing with the headwinds. We were dealing with headwinds in the economy pre-COVID, and with the COVID overlay, it becomes even more complicated for the financial markets to fully comprehend what is going to be the extent of the damage to their credit exposures. So it is but natural that as from 2014-15, that in the Indian financial markets, we had started preparing for dealing with the increasing volume and value of non-performing assets. With the introduction of the IBC, that provided a great boost to resolution mechanism that wasn't there earlier. That certainly helped in resolving some of the large exposures initially, but I think total volume of requests that went into the IBC or the NCLT into the courts sort of completely overwhelmed in terms of the volume, and the borrowers also got very smart in sort of in figuring out through good lawyers of how to ensure that they could protect their interests, while obviously the committee of creditors were trying to protect their positions as well. This has worked quite well, and I must compliment the government and the regulators for actually making certain amendments and adjustments to the IBC as they figured that these were the challenges that the entire IBC process kind of had vis-a-vis resolution of some of the large and medium-sized troubled assets that had gone in for a legal guidance on the same matter and decisions to be taken. It was in 2018 that the Sashakt committee was formed for finding some alternates, and I had the privilege of chairing that committee, and we came up with some options to which were creditor-led resolution, and that enabled the development of the intercreditor agreement, which was earlier voluntary for the banks to execute, and now the Reserve Bank of India has made it mandatory. The platform there was eventually to have a creditor-led resolution mechanism, which would sort of enable some of these troubled assets to move from the banks into an AIF or an AMC structure, and there would be investors who would be investing into those kind of assets and would, over a period of time, create value in those assets. While the intercreditor agreement has been fully implemented, however, I think what we were expecting, the number of AIFs and AMCs to sort of to take positions in some of those assets has been lower than our expectations. There are a number of funds who are looking at it, but I think this will certainly provide another opportunity that needs to be fully capitalized. In the meanwhile, while this is happening, the banks are obviously have a challenge in terms of either waiting for the resolution through the IBC mechanism or trying to work out directly with the borrowers a resolution or a decision that needs to be made of how much the haircut the banks can take on these timely resolutions of those assets. There is also work in progress on with the regulators on perhaps coming up with pre-pack solutions. And I believe that we may see something on that front pretty soon. It may start with the small and medium enterprises, but it will definitely sort of move into the resolution of larger assets as well. There is talk about one-time restructuring. The Reserve Bank is looking into that. And we also hope that the Reserve Bank of India can come out with some structure there which will help with one-time restructuring. The asset reconstruction companies are another platform which hopefully, if as they get more capital, that could be another platform for resolution of the assets. And I think I would also like to conclude my opening comments with a positivity that I'm now chairing Yes Bank. We are the first bank-led resolution structure that has been put into play. And what we have seen as to how we have dealt with this because of the support that we got from domestic banks, the Reserve Bank of India, the government, from what was a very critical situation for the bank and would have had led to also systemic risks. We have now been able to raise $2 billion of capital. We've just announced our results today, quarterly results. We've turned positive from a $500 million loss in the previous quarter. So I just want to leave this group that there are solutions, there is work in progress, and I think we have to stay positive to be able to deal with what would be a complex situation. I'll stop here.
Great, thank you, Sunil. Cyril, if you could offer your opening comments, and then we'll begin the panel discussion.
Thank you. Pleasure to be here, and thank you, USIPF, for having me on this panel. Just to build on what Sunil and Ambassador Wisner said, I think this topic about stressed assets, and particularly with a sharper focus on the Insolvency and Bankruptcy Code, popularly called IBC, has been a critical part of the discourse in India for the last several years. And that discourse began about 5 years ago, if not more. In 2016, we had the legislation, and in 2017-18, it got the real impetus when the RBI stood behind this legislation and started directing banks to submit cases to bankruptcy, starting with what was popularly called the Dirty Dozen. And since then, it has only got momentum, and the number of cases have gone up dramatically. Apart from what Sunil mentioned in terms of very proactive executive and legislative cooperation and flexibility in making quick changes, I should also compliment the Supreme Court. In my experience, in this legislation, more than any other economic legislation, the Supreme Court has delivered more landmark judgments in this sort of period of 3 to 4 years than in any other legislation that I'm aware of. And I think this legislation, the IBC, has really come alive because of the proactive manner in which all arms of government, whether it's the executive, whether it's the legislature, and the Supreme Court, have been responsible for pushing this forward. So I think this represents a very significant change from the pre-IBC environment, where debtors never took creditors very seriously, to a situation when the IBC came into full force. That IBC was really an entirely game-changing and market-changing development. Now, why is that so? Why is it that it was so important? I mean, we can go on and on, but in the few minutes that I would like to introduce this, I think a couple of points. Firstly, it brought in a rule-based system, moving from what was the erstwhile rehabilitation and then recovery to a resolution framework, bringing it on par with many insolvency frameworks across the world. So it examined, when before the legislation was brought in, there were many comparative examples that were reviewed, including the UK and US, and we made a conscious choice to go with a creditor in possession model, but benchmarking several aspects of the code with global standards. So it was a top-notch and well-conceived legislation, and that to implant it, so to speak, on Indian regulatory soil. It was meant to address the massive NPL crisis, which had become a cancer in the system. And just to build on what Sunil Mehta said, in terms of the size of the problem, even today it's a very big issue. And the estimates of terms of what size of the asset book is infected, it's somewhere around 12.5% now. And it's expected that post the COVID sort of crisis, the fog becoming clear and moratorium being lifted, that it could be anywhere even around 15% or more, which means there is a significant problem brewing at the moment. What's happened more recently because of the pandemic and the economic havoc that it has unleashed, we currently have suspended for a short duration the Insolvency and Bankruptcy Code. It was done by way of a legislative amendment, which authorized the suspension for a maximum period of 12 months, comprising 2 installments of 6 and 6 months. So we are sort of roughly halfway through the first 6-month period, and we'll see whether it gets extended. The outer date is 24th March 2021. So at the moment, the Insolvency and Bankruptcy Code, at least in terms of creditor filings, is on hold. But in the meanwhile, economic distress is clearly increasing thanks to the pandemic, and what is being explored are other options. So the legislation has 4 pillars. Of course, we have a special court for the NCLT, which apart from many other jurisdictions, has the IBC and bankruptcy jurisdiction. We created a new profession of resolution professionals, or what internationally would be the administrator. And we have a new regulator, the IBBI, which regulates all manner of professionals who function for the insolvency regime. We have a 4th pillar which has not yet come into effect, which is the data repository, but that's not relevant just now. So what's been the impact? I think the impact has been manifold. Our ranking as a country in terms of resolution of insolvency has jumped up dramatically by many points, by over 37 points. Our ease of doing business ranking went up, and one of the biggest boosters to that was this. The recovery rate. So when the rubber hit the road, the recovery rate went up from 26% in 2018 to around 72% in 2019. There's almost a 3-fold rise. The time for resolution, which was earlier an average of about 4.3 to 4.5 years, got crushed to about 1.6 years. And it's expected that had there been kind of more judges and more efficiency in the system, we would have been able to sort of bring down the average to less than a year. Now in March 2020, which are the last published data, there were about 3,700 resolution plans that were submitted, companies submitted into insolvency. 221 got resolved, 300 odd got closed, 150 got withdrawn, and 917 companies went into liquidation. This is quite impressive. So currently, as I said, we have a suspension of the IBC, which was an appropriate emotional policy response at that stage, because just as the pandemic was unfolding, I think the government was effectively in not only in a panic mode, but it was likely to see the destruction of a large part of the small and medium enterprise sector, and they needed this protection. But of course, now the unintended consequence and the criticism that we're seeing is that it is being abused, and that debtors who probably are in financial distress, not just because of the pandemic, are hiding behind this moratorium. But we'll see about that. Looking forward, I think we are going to see many changes. Topics on the horizon include the pre-pack regime, which Sunil mentioned. I think at some stage we will see the notification of the cross-border or the model code. That has been ready and sort of ready to go for a bit. but at the moment it has been suspended, and I think that will be of direct relevance to the international audience. I think we will probably see the arrival of a financial sector resolution code. There is a lot of policy thinking going on about this. As a practical matter, a yes bank type situation was using a very different route. We are halfway through the resolution of the ILFS, which is a non-bank finance company, and another kind of hybrid real estate slash NBFC DHFL. These are massive financial sector restructurings. But I'm hoping that we will see something more substantive and probably even a bad bank, and we'll talk about that later during this. There is policy thinking going on, at least started in relation to a UK-inspired cross-cram-down type of provision where even if one class of creditors were to approve a scheme, that it could be notified. Of course, this is early stages, but there is a lot to look forward to. The next 8 months, 5 months of 2020 and 3 months of 2021 are going to be crucial. And come April 2021, I think we will, once the curtain lifts, we'll see what has happened. And once the tide goes out, we really get to see sort of who's not wearing clothes. So with those introductory comments, I'm going to hand it back to Stephen, and we'll go through with the panel discussion with the rest of the experts on the call.
Thank you, Cyril. And let me add my thanks to being invited to participate in the panel and to moderate now going forward. I will also, where appropriate, add observations and information regarding what's happening in the United States market. But I will tell you that US investors are keenly interested in the India distressed market, have been for some time, and will continue to be. In terms of the panel going forward, I think we're going to turn now to Dhananjay to talk a little bit more about the IBC in terms of an overview, but also focus on the impact of the current amendment that has taken the IBC and put it on hold. So Dhananjay, can you take it from here, please?
Sure, Stephen. So in addition to what Mr. Shroff was talking about, there are Indian system has always seen a bit of delay in courts in terms of security enforcement, in terms of resolution of companies, in terms of rehabilitation. And now what the IBC did, the impact of IBC was in three areas. Number one, the control of the company was sort of immediately changed from the debtor to the creditor or an independent insolvency professional. Secondly, there is a time-bound process. Although we spoke about the average time being 1.5 years, the aspiration is to bring it down to less than a year. 330 is what the law says. So time-bound resolution is very important from an Indian perspective. And lastly, arriving at a resolution plan which provides for resolution of the entire company, binds all the creditors, and provides for restructuring of the debt of a company in a sustainable fashion. So if you combine these three, a lot of issues that the creditors in India have faced will get resolved. And that is the intention of IBC, and that's the sort of change that is being brought about. I would say it is happening in 3 phases. First phase, in terms of looking at efficacy of a creditor in possession or creditor in control regime, in terms of having the debtor realize the power of the law, has already been felt. There has already been a sort of shift in debtor-creditor relationship, which now gives creditor much clearer power than it was before IBC came in for their security for their debt. So that is that's I would say is the biggest change. In terms of what is happening just now, what we have seen is definitely an assessment of the government that the industry, the economy is in bad shape in general, and therefore they need protection from creditor action. The industries will need to think of consensual solution rather than a bankruptcy or something that can have a problem on a value of the business. And that protection is what has led to the so-called suspension of IBC. Currently, we have the regime is for any defaults committed within these 6 months, starting from March 25th till 6-month process just now. It can go up to a year. Currently, it's for 6 months. This restriction continues for forever. So any defaults that have occurred during this period, formal insolvency proceedings cannot be uh, initiated at any time by any creditor. And the restriction is not only on creditor, the restriction is also on a debtor to start the proceedings themselves. So that's the appropriate response of the law to the COVID situation. The another factor to keep in mind is the way the test of insolvency that the IBC adopted was a payment default and not a subjective test of, say, an inability to pay or a balance sheet insolvency. So it's a more cut and dry payment default test, and the merits of that default as to reasons of that default need not be gone into. So even for the suspension, they have gone with something similar. For any default which is during this period, they need not go into why the default happened, whether it was COVID induced or otherwise. They need not go into. And we have also, the law also has now provided, exemption from insolvent trading in relation to such default which happened during this period. So those were, Stephen, some of the initial points and what are the changes that have happened because of COVID.
Great, thanks, Dhananjay. I would also remind our audience that if you have questions for the panelists, you can use the chat feature on Zoom, and then we'll try to answer everyone's questions. Let me turn it over to Vish now to walk us through what we're sort of going to call the toolkit for creditors and investors under the current environment, and pick a handful of the most prominent.
Thank you, Stephen. I think what I'm going to sort of talk about will resonate a lot with what Ambassador Wisner spoke about in the beginning, that it's important to preserve value, from companies which are in distress, because there is a lot of value, which can be sort of, preserved and protected. And it'll also tie in with what Mr. Sunil Mehta, touched about in the beginning. Since the IBC has been blocked, for a period of time, I think the focus is now to find out what are the alternatives which are available for resolution. That has been our biggest sort of, problem in not having a viable alternative outside of IBC. IBC, which has made significant amount of progress in the last sort of 3 or 4 years, but equally the judicial system and the NCLTs are having to deal with the burden of the innumerable number of cases which are going there. And that's sort of the legacy cases. If you add the COVID impact on top of that, I think we have a huge problem, to deal with. So I think the need of the hour is right now to focus and strengthen alternatives outside of IBC, which can cater and provide a similar outcome, but potentially with a different process, which doesn't rely too much on the legal and judicial system, but has a system of checks and balances, which can provide the same result. Mr. Sunil Mehta talked about the RBI framework and how the RBI has mandated an intercreditor agreement to be signed amongst banks. But the trouble with that has been that it only caters to a certain set of players in the market. It doesn't sort of cover non-bank institutions. So the focus has been now to align the various regulators, RBI, SEBI, pension fund regulators, and all of them to come together to put together a framework by which you can create a solution for resolution outside of IBC, which can then sort of be taken to court for a blessing and be implemented. And I think we may see the early signs of that for small resolutions in the MSME sector, as Mr. Sunil Mehta sort of touched upon. But I think we really need that for even the large resolutions. Otherwise, we won't be able to cope with the volume of cases which may sort of come about. Now, how do we achieve that? Pre-pack is one solution, but I think the other solution is really the voluntary scheme, voluntary, liquidation, voluntary resolution scheme, which is very prevalent in UK, Singapore, etc. What we found very interesting was the UK has actually borrowed the IBC model by introducing a single class cross cram-down measure. 75% sort of majority across one class can, effectively bind everyone. And you don't have to look very far to find where that has come from. It's actually come from IBC. So what UK has done is borrowed that from IBC. And I think what we need to do now in India is to strengthen the Companies Act regime for creating a scheme resolution, which actually adopts what we have in IBC. And that's already happened in the UK. So this is something, we are putting it on the agenda of the Indian sort of stakeholders, and we are going to be leaning on Mr. Sunil Mehta to sort of throw his weight on this issue as well, and making that as a center stage. Because unless we strengthen the alternative mechanism, be it the integrated agreement, create a framework by which all stakeholders are bound by a resolution, introduce a system of checks and balances to deal with fairness in process and an outcome which will protect value, I think goes back to the point which Ambassador Wisner sort of spoke about earlier. There is value in all of these assets. We need to make sure that people who don't have any real say in the resolution cannot block it. And I think that formula is a cross-class sort of cram down with 75% majority or what have you, or what we have picked in India, which is sort of 6/6 2/3. So I would really sort of say that we as sort of stakeholders need to sort of put that on the agenda of the government and take it to its sort of logical conclusion. Back to you, Steve.
Yeah, Vish, let me ask you, are there examples of prominent successful pre-packs? And can you also comment on other examples of successful restructurings?
I think Yes Bank is a very successful example. I mean, for lack of a better explanation, I think it was really a deal which was done, sort of bringing in public sector banks and sort of private sector banks in the form of a, pre-pack and implemented through the Banking Regulation Act and the RBI sort of.
Except it was not a scheme.
Yes, it was a recapitalization scheme, not a resolution scheme, but it was a bank recapitalization scheme, and I think that's a very good model, but can't be used, all the time. But we really need a framework by which there can be a. Though we had a moratorium for 1 month, I think the resolution was achieved in about 2 weeks' time. If I'm not mistaken, I may be off the mark by a few days here and there. Several other successful resolutions which have happened in IBC, Stephen. SR Steel is one very prominent example. Bhushan Steel, another prominent example. JP Infratech, more complicated, but has sort of reached the outcome of a conclusion. It's in sort of the implementation stage now. So yes, we have had very successful sort of examples. But if I look at the present situation, what is the new flock of NPAs which are going to be added post the moratorium of RBI being lifted? There is going to be a lot of these cases coming in. So unless we strengthen the alternative resolution mechanism and give it some teeth and an effective tool to implement, we're going to have a big problem. And therefore we need either a pre-pack or a company resolution scheme, which needs to be strengthened to take us to its sort of conclusion. Back to you, Steve.
Great, thanks, Vish. Let's turn now to various investment opportunities in the Indian market. And I think, Abhijit, do you want to kick it off with what the opportunities are for new capital providers?
Right. Thanks, Stephen. So I think it goes back to what we're currently facing because of COVID. I think there's a double impact. The financial sector in India was already facing some stress going back all the way to October 2018. NBFCs, which are the non-bank capital providers, and mutual funds, which have in the last couple of years really played an important role in providing debt financing. Both these sectors were leading up to COVID themselves facing some redemption pressures. Access to capital was not that easy. I think what's happened with COVID is that it's added a double whammy. So you have the moratorium, which has been imposed by the RBI, which essentially gives a 6-month holiday for repayment. And I think lots of people are looking at 31st August as a looming deadline for a sudden escalation of non-performing assets. That, along with the impact on cash flows, I think we are looking at not only traditional businesses looking for capital, but even your traditional capital providers, which is banks, NBFCs, being constrained. So I think we've already seen stronger credits going to the market for fundraising. We've seen a couple of large private sector banks already having raised significant equity. There's talks about a second round of recapitalization for public sector banks. So I think there is definitely, and it's undeniable, that the Indian corporate market will need new capital. I think the investment opportunities only increase because your domestic traditional sources of financing will be constrained for cash and deployment of capital. So I think it's natural that there will be opportunities. I think quickly, I just want to tie it up with what Mr. Sunil Mehta and Mr. Vishwanathan alluded to, is ultimately investors will look at, while there is opportunity, they will want to be sure that they have weighed the risk properly. And therefore they will look at the tools that they have to recover their investment. And that's where it becomes important that, given that IBC, even if the measures ease up a bit, there will be a tremendous strain on the IBC infrastructure, whether it's the office holders or the judicial systems who already need to deal with the backlog of cases. You need to have a toolkit which protects value for the new investors, whether they're coming in through the debt route, whether they're doing hybrid structures or just plain equity. I think that if that structure is and that infrastructure and toolkit is put in place, I think there's a significant opportunity for foreign capital to be deployed in India.
So let me follow up with a question, maybe I'll throw it out to the whole panel, but in terms of investment, how would you comment on the level of outside India investment, both pre-COVID and the extent to which, even though we've been in COVID for less than 6 months, but what's the change, if any, in terms of foreign investment?
You want me to take it?
Yeah, Mr. Mehta, I think, yeah.
Yeah. So, what has just been said is that, and Abhijit sort of alluded to, that the bank's balance sheets are going to be strained. There is obviously a limited amount of capital that would be raised. So the banks would have to figure out smarter ways of dealing with their stress asset books. And it is a great opportunity for investors to come in and look at some of these assets which the banks would want to lay off from their balance sheet and would want to partner with investors. Now, there are many ways of looking at it. You can do it through an ARC structure, AMC, AIF structure, or a special purpose vehicle. The important element, Stephen, is that the replacement value of those assets on the ground is very high. Many of these are very good assets. As you know, that under the land acquisition laws, it's becoming hugely complicated to acquire land, to set up new significant plants that have been already set up. Real estate, a huge amount of real estate is sort of been stuck and bedeviled, including in the hospitality. To replicate those real estate assets is going to be very, very complicated. So there is really, because of this COVID and the headwinds that were there, economic headwinds, so it was maybe a year or two down the line, demand would have picked up, or demand will pick up, and hence there will be a value creation that is there. So if these structures that we're looking at, and we ourselves are looking at it at Yes Bank, to see if that is possible and get the regulatory compliance or regulatory approvals of the same, I think these would be quite useful for us to spearhead. And if some of them succeed, it would provide very interesting opportunities for global investors. The aspect from a global investor's point of view is the governance, the quality of the governance. That was something that had sort of worried global investors and domestic investors, rightfully. That is being dealt with, because we all know that if we don't get proper governance into wherever people are investing their money in, which means changing the behavior of the way the promoters used to run those businesses earlier, or changing the promoters themselves or the management. The entire aspect of navigating the domestic policies or issues. So it is also important from the partnership perspective that who does a global investor partner with on the ground to be able to navigate and deal with the domestic complexities in dealing with the resuscitation of some of these investments that are there. So I think we've sort of spoken about many new alternatives that are being explored. And I'm reasonably sure that at this point of time, when the entire system has their backs to the wall, whether it's the government or the regulators, they will definitely look and are open to new ideas. And if they see something which makes a lot of sense and takes care of even the domestic issues, they will be open to sort of dealing with it at the earliest to allow the transition from the banks into other, whether it's other structures.
Great, thanks, Sunil. And speaking of new ideas, let me throw out this question that that's been posed to the panel. What is the case for changing capital structures in India, given we have always been scarce on capital? The right balance of equity and debt would enable revival, lower reliance on Indian banks, except for maybe working capital. Who wants to chime in on that question?
Cyril, you want to?
No, let Vishwanathan go with it and I'll add.
Okay.
You're on mute, Vis.
I'm just unmuting myself. Thanks. I think, technically speaking, there's no restriction on capital structure. I think it's about, at the end of the day, for foreign capital to reach India, we have sort of conventional routes and, new routes as well. But with the FPI regime, I think we have sort of largely overcome any restrictions on, providing, the required capital for, Indian companies. I think the capital providers are more concerned about, the kind of issues which Mr. Sunil Mehta sort of spoke about, be it governance or, the points which sort of Abhijit made about, you may be an equity investor in a bank, but you're still looking at how effective the recovery sort of laws in India are, because, you're looking at how the bank is going to sort of realize, value, realize sort of, its own sort of investment. So I think it's the entire ecosystem which sort of will have to sort of work together, for all of this to sort of succeed. It's like, when we approach, a bond market, the bond investors are looking at, the entire sort of legal system, and, IBC itself has a very strong tool for, making the bond, market more attractive. So I think we need to sort of, the ecosystem needs to sort of, improve. I think we have made sort of significant progress. Of course, the technical rules will always have to evolve. For a public company, you've got some restrictions on, convertibles, warrants, but I think those are all sort of matters of detail and they can be overcome or structured around. But I think here we are looking at a larger issue of how do we sort of strengthen the ecosystem for getting, better capital in. And I think those are all the issues we are, trying to deal with today.
Thanks, Vish. Cyril, did you want to add anything? Oh, sorry.
Yeah, this is actually quite an underutilized part of the IBC and the company's schemes of arrangement, where most resolution plans have effectively meant sales of assets or just sales of the business. I think we need to now move to the next level where a capital reorganization is also part of the option of possibilities. And I think going forward, we might see some of that come in as well. But if particularly if a pre-pack regime is introduced, you might see capital reorganizations and infusions of equity as part of the resolution process rather than only basically a sale of the business, because that becomes a kind of an M&A transaction rather than a resolution. And that's actually been one of the flaws of the resolution process till now. But going forward, I think that will definitely change. And actually, Yes Bank is a very good example. Even though it was not under the IBC, it was essentially a recapitalization scheme. And of course, a bank is a bank, so that I think that stands on a different footing. But as far as non-financial institution resolutions are concerned, there is clearly an opportunity for a different genre of resolutions.
Great, thanks, Cyril. The follow-on question, which is as follows. Distressed deals are most likely control deals. Governance can come in easily. Are investors willing to do hybrids? not from a legal perspective, but from a commercial perspective.
I guess this is from Abizer of
Yes.
EY. So Cyril, you want to take that?
Actually, let Dhananjay take that and I'll add to his comments.
Sure. I would say it depends on, there are a couple of things. One is the foreign capital that is coming in. Some of the investors are used to control type deals. Some of the investors are not. Some of the investors are sort of looking for a minority or a smaller stake, and then you know work on that capital. And there are few investors now who are looking at full sort of control deal under IBC, because it comes with full operational responsibility. But it is not as if this has not happened. There are a couple of examples where financial investors have done what we call loan to own deals, what they have done in terms of conversion and taken control of the company, used whether it's advisor or consultants, or built their own teams. And we are starting to see this a bit even in the ARC side, where ARCs are looking to build their operational and turnaround capability to deal with their stressed asset. So yes, it's a nascent trend. Whether everybody has the capability and expertise to do the kind of turnaround that is seen in many other markets is something that will evolve in the Indian market as well.
Cyril, I didn't know if you.
Yeah, I think that's sort of absolutely right. And there is a kind of generally a sort of a shortage of management talent for taking over the operations post the resolution. So I think that is part of the problem as well. And I think there's clearly a market for sort of effectively a new type of service where managements can come in and sort of tie up with the financial investors or the incoming the resolution applicant, who they can partner and really help in the turnaround as well. And that's a gap, which is why you find that in many of the important cases, it has been essentially a strategic that has come and taken over the unit in an M&A transaction or a full acquisition, rather than any other format. And that's been clearly the underlying insecurity in the type of resolution proposals that have come through.
So maybe I'll turn now to the US experience and briefly comment on that. Unlike with your moratorium on the IBC, our Chapter 11 process is still in full force and effect, although there have been significant changes to the way that we're conducting these cases. Maybe the best way to look at it is by industry. By far the most hard-hit industry has been the retail sector. We've never, obviously, many of us experienced the financial crash in 2008, 2009, where obviously there was substantial distress, but never have we seen whole industries in which you went from well-performing, well-capitalized businesses to having zero revenue. It's never happened before. No one could ever have anticipated it, and no one was prepared to deal with it. The biggest losers in the US have been landlords. There is nothing in the bankruptcy code in the US that would allow for a tenant to not pay rent during the pendency of the Chapter 11 case. However, almost every court that's had a retail filing in it has allowed the debtor to ask for a moratorium on paying landlords. And that is now extended for 3 and 4 months. We're now going to see landlord bankruptcies, shopping center owners who are going to have to file for bankruptcy because of lack of revenue. But we're kind of making it up as we go along, and courts are in some ways assisting, even though it's not permitted under the bankruptcy code, to try to find some equilibrium or balance. But landlords are substantial losers. The other problem with our bankruptcy code is, and I don't think it's different for IBC, it's just a process. It doesn't print money. It provides an automatic stay or a moratorium, But if you look at, I traveled for the first time last week. Our court hearings have been, in some cases, suspended or all done like we're having our Zoom call now. But I had to spend 3 days out of town and going to a hotel for the first time and seeing no one there. You know, we're starting to see hotel chain bankruptcies. The airlines are struggling, and our Chapter 11 system really is not well equipped. One of the things that our firm is doing is we're about to propose legislation. We're going to wait till after the election, but we're going to propose some legislative changes to the bankruptcy process for medium-sized and smaller Chapter 11 companies to try to streamline the process. You may know that, and this is kind of counterintuitive, but we can spend, you know, hundreds of thousands of dollars just to put a company into Chapter 11. And it's a ridiculous process. It's great for lawyers, but it's not good for the system. And we're going to propose changes that streamline that. We also want to streamline a sale process. Most of our Chapter 11 cases end up in sales under Section 363 of the Bankruptcy Code. We want to streamline, you know, that process. And the final comment I'll make is there have been an increase in Chapter 11 filings, but the deluge has not started, in part because of the bailout funds that our Congress has given to companies. Smaller companies have gotten what are called PPP loans, payroll protection program loans, and I think it's almost $800 billion of these loans have gone out to smaller businesses, and they created also for larger businesses a Main Street lending program. Those are going to come to an end, and then we're going to see the deluge. And there's been a lot written on how our court system will basically become, you know, unable to handle the number of cases that we expect. So there's a lot going on, you know, over here, and none of it is really good. And our system is going to be really challenged to cope with it. Let me.
Second, and there's one key difference
Sure,
on the Indian side is that
Yes.
we don't really have data filings. So the suspension of the code was sort of meant to essentially for creditor filings, where we've kind of thrown the baby out with the bathwater, and there is no opportunity for debtors to kind of seek bankruptcy protection or to seek a reorganization. So I think that is definitely one of the problems. And once there's sort of more clarity on the moratorium, I think we might start seeing some data filings as well. So that's kind of got informally suspended too, and that's the problem.
Yep, I hear you. Let's turn to the possibility of creating bad banks in India, and whether that's really feasible, and ask both Sunil and Cyril to comment on that.
Cyril, you want to go first and I'll follow you.
Yeah, this has been kind of a long-standing discussion that has been going on for creating a bad bank, and I think the moral hazard issues have usually always come in the way, and it's a big political decision. Part of the criticism has been that if you kind of just do it the old-fashioned way, you just transfer money from one pocket to the other of the government, because the government will try to keep control of it effectively, and the funds that will be brought in for sort of recapitalizing will essentially come from either government or quasi-government sources. So there is a fresh impetus to this dialogue at this moment, and I think there is the commentary that's on at this stage is that yes, it's a good idea because it would be a good way of cleaning up the problem and allowing the banks to sort of have the bandwidth to get on with life and business. However, you have to make sure that it is done properly with good governance, and definitely not with 51% government control. The control should be with the private sector and an expert group of investors who would bring in both private capital and global best practice. So this conversation, I mean, there have been, this has been lobbied with the government. I think there are thought papers which are lying on the desk of some ministry somewhere. But we've not heard much back from the of the government yet. It's definitely in the pipeline, but the policy response, yes, has been a bit muted. Maybe they're waiting for a bit longer to see how this moratorium business goes. But I think the time for an Indian bad bank has definitely arrived. The erstwhile sort of virulent response to it has muted a lot. But we are still, in India, nothing happens in one go. It's like a TV serial. You have many installments. It's not one shot.
So let me add to what Cyril has already said. First of all, the nomenclature of a bad bank is not good to get it through. So you have to call it something different. It just does not have the right feeling in a marketplace like here. So please do not call it a bad bank. You can call it in any other form or shape. The second one is exactly what Cyril has said, that the burden of the funding this bank or the restructuring bank or whatever you want to call it shouldn't be with the public sector institutions, or you shouldn't burden the government with it. Third, to attract global investors and diversify the base, you need very strong governance practice in the way it's going to be managed. Fourth, if any global investor finds that it is being there's backseat driving, or there is any government, the government or the state-owned institutions would want to move their assets from the banks, the troubled assets, into this, which may or may not be at fair market value, then that would also sort of create a situation where they would sort of be not keen to invest in this kind of a institution. Fourth, they obviously want the governance structure and the decision making to be absolutely standalone, so that they can also look forward to the right returns as they over a period of time. So there are many aspects to this, and I would sort of, at the cost of repeating, these were some of the issues that we had actually taken care of when we made our Sashakt committee recommendations to the government. And I think whether you call them in which form or shape, but there is still a room for global investors and domestic investors to get together to put this in motion. And there would be opportunities for them as well.
My guess is we'll see a number of kind of ARCs or special funds with specific focus on sectors. There could be one, say, for real estate, or another one for airlines and things like. You'll see sector-wise kind of better names.
Great, thank you. So we're about out of time. We've run over, but we'll still spend a few more minutes. We've got two other questions if we can try to answer them. This is from Niraj Seth. The impact of COVID will lead to higher defaults and distress globally, including in the developed markets. India is no more the only large economy with distressed opportunities, and the well-publicized shift in creditor protection framework with IBC is under question mark. What are the initiatives from the government and regulators to attract foreign capital going forward? Who wants to take that one?
LV, you want to take that?
I can take that. So I think the Indian regulator, particularly SEBI, has sort of actually been proactively trying to deal with problems we've had raising, equity for distressed companies. We've had pricing norms; those have been sort of reconsidered. Also, dispensation from the takeover code, that also has been sort of granted for companies in distress. I think these are good signs. Now, if I were to look at it, these were, significant hurdles or, problems which could, which precluded market-based solutions for some very well-known deals in the past. So be it sort of Jet Airways or, even for that matter, sort of Yes Bank. If some of these changes were made 2 years back, we could have found market-based solutions for some of the problems. So I'm hoping that the regulators are sort of quite keenly looking at enabling foreign investors to come and participate. And I think the kind of measures we spoke about on this discussion will also help in strengthening the legal framework for foreign capital providers to come in and participate.
Stephen, if I can supplement that.
Sure.
The RBI also came up with draft guidelines for sale of loan exposures. And there is a clear indication of what form the guidelines will finally come in, but there is certainly indication that the RBI wants more wider play in the secondary debt market, and they are allowing every regulated entity who is otherwise permitted to acquire loans to acquire NPA from banks. So I see that as a significant move. And in fact, there have been a couple more moves. There has been a change in our foreign currency borrowing guidelines last year, which has now permitted foreign currency lenders to directly take over Indian loans from the borrowers, so that as part of the IBC process or otherwise the resolution process. So that has also significantly made participation of foreign debt capital easier. So this is in addition to what Mr. Vishwanathan was talking.
Great, thank you. So Abazir's asked a question really of me, but part of it I'm going to throw out to the panel and then we'll wrap up. And the question is, what is the experience of mandated standstills globally? What are the issues in introducing them in India that would expedite resolutions? So my observation globally, Abazir, is that we have a multitude of regimes that treat this differently. So US is a debtor-initiated process, unlike yours, and unlike administrations, for example, in the UK. Debtor-friendly regimes all have standstills, automatic stays, moratorium, whatever you want to call them, because they're debtor protection focused statutes. It's very customary for us here. That's the primary protection in a Chapter 11 case, is you have a stay of all manner of creditor remedial action. If you look at the UK or some other jurisdictions, Singapore, for example, there are limited moratoria, but they're creditor-driven statutes, and so they're less. They allow for less in terms of a moratorium. In Singapore, you have a 30-day standstill, but it doesn't apply, I believe, to secured creditors. So there are exceptions for certain parties. So it's hard for me to comment on the issues in introducing them in India, but I would imagine that given the fact that you're a creditor-initiated process, there may not be the intestinal fortitude for banks and others to allow is probably not the right word, but I would imagine they would not want to see that happen. From a U.S. perspective, and because this is what I have always worked with, it's customary, and so therefore we're used to it. We like it. Creditors understand it, and they get it. But changing that kind of regime in India might be hard. But I'll defer to my Indian colleagues to answer that.
Dhananjay, you want to take this?
Dhananjay, you're on mute.
Yeah, sorry. We also have I think his question was more on sort of mandatory standstill as part of a COVID response. So we have also looked at, I think nowhere in the world I have read of a permanent or a forever restriction on filing of insolvency. Probably Singapore is the one which comes the closest in terms of, because they have in fact imposed a standstill and even on termination of contracts in addition to creditor action. UK has also, with their new law, has looked at both winding up as well as they have brought in a new scheme. They have provided a no reason moratorium. So that definitely in terms of, if you look at the standstill that we have seen across the world, we have seen wider as well. We have seen slightly more restricted as well, but we have not. I think the cloud. We do not think that this will take care of. This will prevent NPAs from going up unless we have very effective ways of dealing with the NPAs in a swift fashion. And I think we have spoken a lot about the alternatives that are today available and the alternatives that could be developed going forward to deal with this issue. With numbers looking at a 13 or 14% of NPA, we certainly need those measures fast and quick.
Thank you. Nelson, I don't know if we have time for one more question. I want to allow Cyril to kind of close us out with his crystal ball gazing for the future, but do we have time for one more question, or do we need to wrap it up?
Yes, Stephen, we can take one more question.
Okay, so here's the question, and it is, does the experience of NIIF help in pushing the bad bank or national ARC proposal? Sunil or Cyril, do you want to take that one?
Well, let me attempt, and then I think certainly the NIF, the setting up of the primary reason was to really fund the infrastructure assets, and the experience that they've had in assembling domestic and global institutions together in that segment has been very successful. They have also put a good team together. The government has supported them in the initial stages, but they have also created a governance structure that seems to be very appropriate in allowing the investment decisions to be taken on a standalone basis rather than being directed from the government itself. So I think that model is certainly which can be duplicated. We can create another NIF equivalent for distressed assets. There is no reason as to why it shouldn't be just one, but multiple of those models that can be there on in the marketplace.
Thanks. Cyril, is there anything you want to add?
No, I think that's a fair answer on the NIF thing, and you wanted me to sort of give some closing remarks and sort of crystal ball gazing. So what do I see going forward? I think the government clearly recognizes that this is one of its kind of primary problems, and they will have to think out of the box to make sure that India doesn't lose the plot on the kind of solvency and the efficacy of its financial system. So I think you will see a lot of flexibility and open-mindedness on legislative reforms. We've seen the government in the past in terms of the flexibility and the speed with which they have brought amendments to the IBC literally multiple times, sometimes in a year. So I think we will definitely continue to see that trend, and our interactions so far with the Ministry of Corporate Affairs, including the new secretary who has come in, have been quite encouraging. They are open-minded about this. Second, I think they will recognize that India is going to require a lot of international capital coming in, and therefore we will also see the flexibility to create structures, including by whatever name called a bad bank or a NIF equivalent or whatever. So new vehicles which will allow attracting private capital. I think we will see that. I mean, looking at it now from a multi-year horizon. In terms of the toolkit, I do expect to see something meaningful on prepacks because they do recognize, I think, and the system recognizes that the lack of prepack in the toolkit has led to some very significant insolvencies, including Jet Airways, which could easily have been saved had that been sort of available. I would expect to see some legislative or institutional framework for resolution of financial sector entities, including the stressed non-banking finance sector. And it's not probably going to be a one structure or one solution fits all. I think we'll see something nuanced for banks, NBFCs, and other types of financial institutions. I do expect that we will also see the notification of the model code for the model law for cross-border insolvency as well. I think India will continue, once we sort of tide over this bump, I think India will continue to be a very attractive destination for foreign capital of all shapes and sizes. So in that sense, this webinar of today is extremely timely. So overall, I'm quite positive. And in today's times, actually, positive is the most negative word that you can say. But I think I'm positive about the future. So on that note, let me end.
Stephen, before we conclude, if I can add to Cyril from development on the ground and what we have seen, and in our case is a practical example in the case of Yes Bank. which has gone through a restructuring process. And I can tell you the alacrity and the tenacity with which the regulators have supported this is unbelievable. The manner in which they have closely kept tab of the developments to deal with issues that we brought to their attention that required some deviation from the way they used to look at these issues in the past. It's a sea change. So while there is a popular perception that things have moved slowly in the past, I can certainly vouch for this, that the government and the regulators and the policymakers are looking at this situation, the COVID situation, and reacting exceptionally fast, understanding the problem, and keeping a very close communication with the affected parties. So I would be actually, I share the same optimism and the positivity which Cyril alluded to. We obviously have a very complex situation. We did have economic headwinds. We've sort of, as I started from my opening comments, the COVID situation adds a very complex overlay. But this is certainly not end of the world. And I think we will definitely learn from what went wrong in the past, and we will come out much more stronger from here.
I would say that given the world in which we currently live in, it's nice to end on an optimistic note. And I just want to thank our panelists for the time, and certainly thank our audience for joining us and for your very thoughtful and interesting questions. And also thank the U.S. India Foundation and the USISPF for sponsoring this and putting this all together. So I hope everybody remains healthy and safe. We will get through the dark time, and we'll talk to you again soon. Take care.
Thank you.
Nelson, you want to conclude? You want to say anything?
No, I'm fine, sir. Thank you.
But thanks to Nelson and his team for putting this together. Many thanks, Nelson.
Thank you, sir.
Thank you, Nelson.
Thank you, sir.
Thank you, Nelson.
Bye-bye.